With the startling and swift resurgence of COVID around the country, our property markets and the future of the economy are a little bit uncertain. So in today's Property Insider video, Dr. Andrew Wilson and I are going to discuss what the Reserve Bank thinks is going to happen, what's actually happening on the ground in our property markets, and boy were there some surprises over the last week in the auction markets. We're going to talk a bit about finance approvals, which are giving an indication of what's ahead, building approvals, plus lots more. If you want to keep up to date with our property markets, please subscribe to our YouTube channel and click the little bell icon so you get informed when a new episode is coming. What a roller coaster ride we're experiencing. The swift and startling resurgence of COVID-19 across the country, it's starting to create concerns, isn't it? It wasn't that long ago that we were experiencing minimal, in fact no cases of COVID around Australia, and we thought we had this coronavirus, didn't we? Then all of a sudden we're confronted with lockdowns, with uncertainty and everything that goes with it. At one stage last week, almost 16 million Australians were in lockdown, suggesting there are likely to be economic consequences ahead. Yet house prices around Australia, they just keep rising. Of course, this is in stark contrast to last year when property values dipped during the early stages of the lockdown. But currently, there are fewer good properties for sale than there are buyers out there, and this is creating an environment that's going to support further house gains until either supply catches up or affordability constraints start to slow us down. As Australia's circumstances continue to rapidly evolve, many are wondering, well, what does this really mean for our economy and our property markets? So I'm looking forward to my weekly Property Insider chat with Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market. Hi, Andrew.
Yes, hello, Michael. And it is perhaps a little depressing, but we move on and hopefully there is some light at the end of the tunnel. I think we're clearly out of that sort of elimination focus in terms of the coronavirus. It's now about controlling it and reducing the health impacts of it. And I think that that's what we've realised now. We have to live with this. There will be variants likely going forward with this particular disease, and we just have to deal with it the best we can. And look, we're doing that now. And I think that this is Australia's lesson to some degree now, is that elimination really can't work, even if we do have Fortress Australia in terms of our geography. It just has such a rapid transmission of this virus that it's very, very difficult to stop. So we just have to work on reducing the health impacts of it and moving on. And in here in New South Wales, we're into our second month of lockdown. It'll probably be another month. The government has forecast or said that they're looking for a 50% vaccination rate, and then they will start to ease restrictions. And I think that's a clear sign that they understand that the balance between a reasonable and orderly life and dealing with this virus has to be one not going to lock us down forever, because the consequences can perhaps be just as bad doing that as they are with living with the virus. And thankfully, we now have another option in terms of the vaccination options that we have. And that looks like being even more effective than the two that we've had now. So it is a medical issue. We need to deal with it in terms of that going forward. And hopefully we will start to recognise that living with COVID means that to some degree we can just get on with our lives, for goodness sake.
Sure. Well, the Moderna vaccine is actually going to give us extra options now, isn't it? And it is affecting the psyche of Australians, affecting small business and the outcomes. But recently, the Reserve Bank, in its minutes, remained optimistic. It learned from last time and says there's going to be a sharp rebound once these lockdowns end.
I think, again, it was a bit of headline chasing or clickbaiting when we had the predictions again of moving into a recession. I think we're a long way short of rationally predicting a recession as a result of what's happening at the moment, Michael. And as you said, there are lessons learned, and that means we've adapted more to these circumstances. Looking at the nature of GDP measurement, we would have to get a September quarter negative figure and then followed by a December quarter figure. We started the September quarter in quite reasonable shape, so I don't think we're going to get a September quarter falling away. And if we're still in sharp lockdown over the majority of the December quarter, well, heaven help us. And then we'd have to have a follow-up over the March quarter. So I agree with the Reserve Bank. I'm not sure we'll have such a sharp rebound, but I don't think we're going to go into a recession, Michael, given current circumstances.
Of course, we don't want to downplay the health effects that some people are having, and clearly the effects of small businesses and economic activity in our labour markets. But I think we agree it's likely to be a temporary phenomenon and things are going to rebound. Having said that, the property markets haven't slowed down, have they? Boy, they had a busy weekend last weekend. I guess we got used to Zoom auctions.
Yeah, I think it's interesting, Michael, that we're still getting high numbers of auctions coming through. And I think we could question that. I think we spoke about that last week, that we are perhaps developing this hybrid auction private sale environment, which we discussed last year, if you remember, that a lot that would have perhaps gone into a private treaty environment when properties were put up for sale are now taking the online auction as an option. And that means we're getting higher numbers of auctions overall, but perhaps they're not as many of those are the traditional at the front of the house type of auctions that we clearly understand as being an auction. And I think Melbourne is a clear example of that. We had another big weekend in Melbourne for auctions. In fact, it was a record opening day for the number of auctions conducted in Melbourne for August. For Sydney was also a very strong August day there. Other capital city markets were around about the same, down a little bit in terms of auction numbers. As you said, the market really shows no fundamental signs of slowing down. There's plenty of enthusiasm, plenty of confidence in the market. I track real-time listings, as you know, and they do revolve around shutdown environments. No surprise, people do hesitate to put their properties on the market in shutdown, and physically they're restricted anyway. And so we do see a falling away of new listings. But we saw, as we've discussed previously, a very significant bounce back following the recent shutdowns in Melbourne once it opened up. Now, again, of course, we've got lockdowns in Melbourne and Sydney, and it is starting to show up again in new listing numbers. So it's a bit of a roller coaster ride in terms of market activity for sellers. But of course, as you said before, that means there's just fewer choices for buyers out there who are still quite capable of purchasing property. Inspections can still be conducted in New South Wales, but they have to be on a one-to-one basis. But certainly transactions are still possible. And if we have fewer listings and buyers are still out there with a strong appetite, which they certainly do have still, then we'll continue to see higher prices and a robust market. But clearance rates were interesting. On Saturday, Michael, we saw the Sydney market move above 80% for the first time in a number of weeks. When we look at the insights to the data, we can see really that was a response to a sharp fall in withdrawals. Now, as the lockdown moves on, of course, people who have booked their auctions in are more rational in terms of the environment they can conduct their auctions. So when we first go into lockdown, we do get a high level of withdrawals in the market. But as the market adjusts to the lockdown conditions, the withdrawal numbers fall away. Now, we only had 10% of reported auctions withdrawn in Sydney at the weekend, which was half that for the previous weekend. And that, of course, means that puts upward pressure on the clearance rate because withdrawals are included as actual auctions. So that means that they're all included as basically past ins. And that means that more withdrawals means a lower clearance rate, and vice versa. The rate of withdrawals was significantly lower, and we had Sydney up over 80%. Again, that reflects more the underlying energy of the market, and we certainly have had fewer auction numbers in the market in Sydney compared to previous months, but still numbers are quite high. And look, it gives us confidence going forward and reflects completely what you're saying, and that is that there's really no significant impact on the housing market through the shutdown environment. And it will be a question of affordability, I believe, more than anything else, that we end up finally easing these boom time conditions. And I'll be releasing my affordability index for the June quarter shortly, and that does show a sharp decline in affordability. Affordability is still positive though, Michael. So there's upside to growth, but there's no doubt that affordability is declining, and we shouldn't be surprised at that with this strong prices growth and with flat incomes and flat interest rates. There's nothing really to increase the capacity of buyers going forward. So everything's still quite positive in our property markets, Michael. There's no doubt about that. The Melbourne auction results were low. They were down around just over 70%. But again, we point to the withdrawal measures as being a reflection, because they actually nearly doubled. They went from 17% withdrawals to nearly 30% withdrawals. And of course, that meant downward pressure on clearance rates. But the number of sales was quite high.
It'll be interesting to look back at the end of the year, some of the thoughts we put out at the beginning of the year. Strong double-digit capital growth. And despite all the challenges the markets have had, Andrew, it looks like we're still going to get that. There's a lot of momentum there. Buyers and sellers have just learned to adapt. Buyers seem to be making quick decisions nowadays, Andrew.
Yeah, I still think we'll be between 15 and 20% most of our capitals by the end of the year growth this year, Michael. So that'll be 2 years of strong growth. Of course, you've got to remember that growth levels will likely ease, not just for affordability, but also because of some of those constraints in the market going forward to the final quarter of the year. But that's no surprise. We expect that. But the point is that we had a very strong market at the end of last year. So I'm not sure we'll get the sort of growth levels, won't be far away over the last quarter of this year that we had over the last quarter of last year. So that'll push those annual growth rates down slightly, but I'd still expect, and they're over 20% now, 25% in Sydney at the moment, annual growth rates.
Yeah.
I expect that to fall perhaps to under 20, but gee, wouldn't be complaining about 20% prices growth.
No. One of the leading indicators, the things that we look at to show what's ahead, is finance approvals.
Yes.
And they've declined again a little bit.
Yes.
Interestingly, a lot of people are borrowing money to refinance their loans. I think what they're doing is renovating their properties and improving their properties rather than moving. Others are still out there, lots of home buyers looking to buy, and investors are getting in the market, but they're nowhere near the levels they were at the boom times when APRA stepped in a while ago.
Yeah, I think there's some interesting points with the finance data, Michael, that we should raise. Firstly, the refinancing, I think, is a reflection of that very strong negative campaign that was conducted by a number of the major banks in regard to predicting that interest rates would rise next year. The Commonwealth Bank and the NAB, they're all predicting, making these, what I believe were really questionable predictions of interest rate increases next year. Of course, they've all backtracked at light speed over the past few weeks because of COVID. That's given them a convenient excuse to change their predictions. But nonetheless, we did see almost a stampede of those looking to refinance on the fear of higher interest rates next year. I think that was a real cynical exercise. But anyway, we move on.
Interestingly, it showed that 46.4% of loans are now being refinanced at fixed rates, which suggests what you're saying, that people listen to those commentaries.
Yes, it's a marketing campaign, and banks are looking for improving their bottom line, and the margins on refinancing also include the fees that are included when you refinance. So I'm not sure they're going to be terrible. I don't think we're going to see an interest rate increase for a long time, Michael. And I've been saying that prior to COVID re-emerging, or lockdowns re-emerging. The finance figures also were very interesting because I actually think, Michael, that we need to understand that I think they actually understated the activity over June. When we looked at the raw numbers, they were actually quite strong May to June. But of course, the seasonally adjusted numbers take into account the seasonality over a period of time, which includes what occurred the same month of the previous year. Now, if we go back a year, of course, we're talking May and June, which was we were in lockdown or just coming out of lockdown, and finance numbers as well as transaction numbers were down quite sharply. And finance approvals tend to lag the real market. So I think that what's happened is that the seasonal adjustment is taking into consideration a cyclical factor, which was that sort of black sheep COVID shutdown, and therefore has given us a seasonal number perhaps that's lower because of the consequences of what happened a year ago. And that means that when we look at the raw data, it actually looks a lot different. And they were quite strong, the raw data, with the exception of first home buyers, on that month-to-month basis. So let's take that with a grain of salt, Michael. I think there's measurement issues there in terms of the seasonality, because it is picking up seasonality that's not really seasonality, and it was really to do with the COVID shutdown. The ABS has been quite clear to look at the trend results rather than the seasonal results because of the issues that we've had in COVID. But I would have thought that a lot of the reporters and a lot of the commentators would have picked that up anyway. That was a little strange to think that we would have had a backtracking over June, given how strong other indicators in the market were.
Interestingly, the media has also been busy talking about APRA or regulators stepping in, because they said annual investor growth is running at 102% year on year, but they're comparing this year when the sentiment is very different from last year, when we were in the depths of still trying to work out what's going on in the world.
Yeah, again, we really get this one-dimensional view of the world from a lot in the media, but the reality is that we've come from the lowest level of investor activity we've had in the history of any of the loan series, the lowest level ever. So of course we've come off that base, given we've had a boom. Banks are starting to become more interested in lending to investors, but the real data tells us that despite increase in investor activity, which was lower than first home buyer activity earlier this year, which is quite remarkable. Never happened before. But despite that growth that we have had in investors are only making up around 25% of the total loan market at the moment, Michael. Now, the long-term average for investors is around 33%. So even though they've come up from 20% on all-time low to 25% of market share, they're still well and truly behind where they have been on average. And even though the corollary to that is that first home buyers have been falling, but their market share is still well above the long-term levels for market share for first home buyers. And this is the point, these things adjust over time. And I would be horrified if APRA, and it would really bring significant questions into APRA, again, if they moved in a market which is clearly easing as affordability bites, where we have very low numbers of defaults despite economic issues. And the reason APRA entered the market in 2015 and 18 was that they were telling us all the next move in interest rates was going to be up. And they had to protect the market from that. Gee whiz, they got that one wrong, didn't they, Michael?
Yes, they did.
So I think it's just, again, clickbait and some cheap headlines from those that should be thinking through this a little bit more clearly.
Sure. I mean, there's no suggestion for the regulators that they're concerned at all. It's really the media. And of course, the media had a bit of a field day with falling building approvals.
Yeah.
But gee, it came off the back of HomeBuilder, which was now unwinding. But building approvals are one thing. It's actually the construction. Construction activity is going to go on for quite some time, Andrew, and that's going to keep the jobs active and actually a shortage of tradespeople and sometimes supply as well.
We're already seeing, we discussed that last week, Michael, we're already seeing higher prices for building materials and labour, offset by the home builder. That's why we didn't see a big inflationary burst from the home building side of the equation in the latest data. But yes, look, that will go on. But we've got to understand that we've actually now passed the record. The annual basis of building approvals for houses has now exceeded its previous peak. So we're in record area now for home building. But of course, that's the annual rate. The recent monthly rates have fallen away. No surprise there. Lots of work in the pipeline. That's a great thing for our economy going forward. And you've got to remember, Michael, those that have really silly predictions of recessions forget that we've got all this building work in the pipeline, which will add significantly to GDP. The other interesting thing in building approvals, Michael, is that we've just started to see a bit of an uptick in unit development.
Yes.
Which I think is quite interesting. Now, again, this is coming from a very low base. Part of the credit squeeze on investors was that it stopped a lot of investment. And we're seeing also, my latest rent report is again showing upward pressure on rents and downward pressure on vacancy rates. And I think that's because there's a lack of investor product out there, or has been a lack of supply. But nonetheless, unit approvals are starting to rise from a very low base. So that was some positive also from the latest building approval data. And I guess we could just sort of finish off, Michael. I just wanted to mention, talking about predictions, that there was a survey released through one of the media outlets of, they have a survey they do of a number of economists, and they were predicting what was going to occur with some of the major economic measures over the next 12 months. This particular survey has been notorious for how wrong it's been. So anyway, so we need to understand that. But I couldn't believe that there are a number who were still having, this was done after the lockdown, or within the lockdown environment, was still predicting higher interest rates next year, right, or early in 2023. And then we looked at the breakdown of those that were predicting it. Some were predicting, as well as that, the higher rates, steady or low incomes growth, and high inflation. What in goodness name would the Reserve Bank be doing if we had a fall in real wages? Because that's what they're predicting. So they're predicting a fall in real wages and yet an increase in interest rates. So it's like, well, that would really start to get us heading towards the territory of a recession, Michael, believe me. So again, we've got to really take a lot of this, and economists haven't really covered themselves in glory over the last 18 months or 2 years, Michael, and I guess it's amusing those that look at these things, but please don't make any decisions based on this sort of nonsense.
I think that's the most important thing to finish off with. Be careful how you make your decisions, and don't make 30-year decisions on the last 30 minutes of news, because we can see, as you said, we've used the word roller coaster a couple of times today. It keeps changing in front of our eyes. So get back to the fundamentals and don't let the emotions sway your decisions as well. Look forward to chatting with you again next week, when I bet there's going to be lots of new things to talk about.
It's a great business to be in, isn't it, Michael?
Yes, there is. We enjoy talking about property, and there's so many new things to talk about each week.